COVID-19 may have changed the way investors are placing their bets on the stock market, seeking not only returns but also positive long-term impact on the environment, society and the performance of the business. Environmental social governance, or ESG investing, has become the buzzword on Wall Street, having enjoyed a rather strong upward trend even when almost all assets took quite a beating during the initial stages of the pandemic. In fact, some market analysts say that these ESG principles are set to define the next decade of investing, as people generally take a greater interest in how companies do business, innovate, adapt to climate and social needs, and also look after their employees. To find out what ESG exactly is and whether it will really characterize investing in the post-pandemic world, we connect with Tim Collar, a partner at McKinsey & Company. He has been advising clients and corporate finance experts for over 28 years, and his book Valuation: Measuring and Managing the Value of Companies, first published in 1988, has become a staple reference for corporate investment, selling more than 1 million copies in 10 languages, with the most recent 7th edition issued this year. A very warm welcome to you, Mr. Collar. Thank you so much for joining us today.
Thank you for having me. I'm happy to be here.
Well, let's go straight into the questions that we have prepared for you. So, over the course of this pandemic in 2020, we saw a rather significant disconnect between the global economy and the stock market. And my question to you, I suppose, is to what extent the stock market actually reflects the current state of the economy or the short-term risks?
Right. There's a couple of things going on in the stock market that are different than what's going on in the real economy. First off, the stock market looks at, to some extent, the long term. And so when you look at how the economy, market expects that the economy will recover in a short period of time, as it sort of shows signs of already doing. And so when you think about the impact on sort of long-term corporate profit, and you think about the value of a company as much about sort of the long term as it is about the short term, it's not surprising that the impact on the market on many companies has been fairly small in terms of percentage terms. That's one thing. The second thing that's going on is that the stock market is heavily influenced by tech companies and pharmaceutical companies and other companies that have held up pretty well. So the market is that we talk about, like the S&P 500, is just a weighted average of different companies. And what we've seen is some companies like hospitality, retail, et cetera, has come way down. Other companies have come way up. But those companies, the companies that have come up are much larger, the tech companies, the pharma companies, et cetera. And so the stock market is not necessarily, doesn't have the same composition as the economy. So for example, while tech companies are very large in the stock market, they don't necessarily employ a lot of people. And other sectors of the economy, like restaurants and those kinds of sectors that employ a lot of people, healthcare, doctors, offices, et cetera, are not represented in the stock market because they're typically owned by private owners. They're not owned by the public. So you do see this disconnect between it. So you have to really look sector by sector to see what's going on in the stock market versus the real economy.
Right. So the listings on the stocks that we've seen just shooting up on the NASDAQ or the S&P, small businesses, they aren't really included there. So you're saying that that's why we've been seeing this rather large disconnect.
Exactly.
While stock prices, as they reflect future value, as you said, what are some interesting things that you think the market could indicate about the industrial landscape in the long run going forward? Which industries do you think are likely to recover rather quickly from the pandemic, according to the market movements that you've seen?
Well, it's interesting that the stock market movements have been reflective of often the prospects of individual companies as opposed to industry. So for example, if you take the retail industry, you find that some sectors which were already under pressure, like clothing stores or department stores, have been hurt quite badly by the pandemic, and the stock market is expecting less of a rebound there, where other retailers, online retailers or general goods retailers, have done much better. They've held up because they're selling essentials that people need to buy even during the pandemic or even increased during the pandemic. So you see this divergence occurring even within certain sectors. So it's impossible to generalize about which sectors will be good or bad. I mean, the tech sector is more driven, for example, by innovation as opposed to the economy. The same thing with the pharmaceutical and healthcare sectors. And that the industrial sectors have been reasonably holding up pretty well. And so I think overall the market seems to be assuming that we'll get back to normal in a year or two, and other forces will come into play longer term. But the pandemic will be something that will eventually work its way out of the system, and the economy will get back to normal, and company performance will get back to normal as well.
And we're very curious to know if there were any major shifts or trends in the market that stood out to you in particular in the wake of this COVID-19 pandemic, and whether you think the pandemic has changed the way investors look at their portfolios.
Well, I think if you look at, when you think about investors, you think about retail investors versus institutional investors, right? I think institutional and retail investors are more easily swayed by the news. They tend to, panic when stocks start going down, or they tend to start to get too excited when things are going up. So it's hard to really predict what's going on there, what they're thinking. But if you look at institutional investors, I don't see a big change in the way they're thinking about sort of the long term.
Right. And prior to the pandemic, there was a noticeable trend going on with ESG funds, and they did particularly well in 2020, I mean, in the wake of this COVID-19 pandemic. So why are investors finding them more attractive during this time? I mean, is it because they're so heavy in tech stocks, as you said earlier?
Yeah, I think that's a lot of it, to tell you the truth. It's very difficult to draw too many conclusions over a short period of time, even 1 year, let's say, or since the beginning of the pandemic. And the problem is that when you're looking at different funds, if you're looking at ESG, the way you should be looking at it to understand the impact is looking at companies within an industry and how different ESG performers within an industry are performing in the stock market as well. And as you pointed out, the ESG funds tend to be heavily weighted towards industries that have benefited, like tech and pharmaceuticals, because they tend to be cleaner industries, right? At the same time, the dirty industries, oil and gas, because of the pandemic, have seen a tremendous drop in oil prices. And there's longer-term bad news coming along as well. And you see that those have been hurt worse, and those are companies that the ESG funds are not investing in. So a lot of it is simply a sector effect, and I think that that's going to be important. If I'm an investor, I need to really think about, am I just getting a different sector mix by investing in the ESG fund, or is there something more fundamental? And I think it's really too early to tell, because most of the ESG funds are still at an early stage in terms of the development. They tend to be more sector focused than stock pickers. So we'll have to see how that evolves. But right now, the ESG funds are still, they're making pretty easy decisions about which companies to invest in and which ones not to invest in.
Well, we're hearing a lot about green bonds, climate bonds, socially responsible investing, and it's a bit confusing, to be honest, as a non-finance expert. So what really is the difference between socially responsible investing and ESG?
Yeah, I don't think there's really any formal definition of those terms. As there in a lot of cases, we used to talk about social responsibility. Now we talk about ESG for the most part. The words have changed. We're perhaps becoming a little bit more precise by using the term ESG, right? Because now we're talking about specific aspects. We're talking about the environment very specifically. We're talking about the social side of things in terms of employees, customers, the local community. We're talking about how companies governed and is with their responsible governance. So the nice thing about ESG as a terminology is that it is much more precise and tangible, and then we can take apart a company and we can look at each element separately. So I think there's a good reason why that term has evolved as opposed to socially responsible. And I think that's probably what more and more will be the term that people just use and replaces the term, the socially responsible term.
Countries here in Asia as well, including South Korea and Japan, the governments are also showing great interest. So do you see ESG-oriented startups, businesses and investment options really broadening as governments around the world, they're really aiming to ramp up their green energy and infrastructure?
Well, yes, there are plenty of companies that are starting up. It's going to be difficult to see, though, how this actually plays out, right? Because if you look at a lot of these investments, right, the investments themselves, like if you think about building a wind farm or a solar farm, it's a fairly commoditized business. It doesn't take very much. I mean, there's a lot of competition. You're not really selling anything unique. So the returns necessarily to investors are not that great when you have something which is commoditized. So the real returns will be in companies not that are necessarily just producing energy using solar or wind, let's say, but will be for those companies that are innovating, right? If a company can innovate in the area of batteries, for example, or maybe a new way of using hydrogen or economically turning hydrogen into a fuel, that's where the opportunities are, is in sort of figuring out new ways of doing things as opposed to just taking existing technologies and applying them. Because everyone has access to those existing technologies. So it's only when you have something unique does it create a great investment opportunity. And the investments of people who are just applying what's already out there probably won't be as strong as those where the companies have something unique to offer.
Right, so any future innovation that we see, for it to really stick, it's going to have to be sustainable and share those values that more and more people are really finding very important these days. But what really determines that, though? I mean, will it become important for ESG criteria and reporting standards as well to become more and more standardized? And what are the most important sustainability aspects that investors look for?
Yeah, I think that investors, once again, the more sophisticated investors, are looking at what are the things that are important to an individual company as opposed to broad things. There are some things like diversity and inclusion which are important to all companies, but for other purposes, I think both the management teams and investors should and are looking at what matters for their business. So for example, if you're in oil and gas, carbon emissions is one of the most important things. If you're a beverage company, water consumption, particularly water consumption in emerging markets where you may be operating, has a big effect on the community. If you are a clothing manufacturer and you're manufacturing in different countries, labor practices will be a big issue. So the challenge for reporting on ESG and the challenge for management is to figure out what really is material to their company, not trying to report on everything or try to do everything. What's really going to what can that company really do to make a difference, to make sure that they are attracting investors who are worried about the environment and about social issues?
What significant changes in investing trends and valuations do you think we might see or develop in going forward in the post-pandemic world?
Yeah, I don't see much changing, to tell you the truth, in the post-pandemic world. Our book has been in the market for 30 years now, and the fundamentals have held up true through the dot-com bubble, the financial crisis, through the pandemic. So the principles of companies creating value by investing and generating cash flows and earning an attractive return on capital, that is universal. The market sometimes gets away from the fundamentals, but only for short periods of time, like in the dot-com bubble. And there was a period, like, say, for example, March of this year, where the market came down way too fast, but quickly recovered. So I think we quickly go back to a situation where valuation approaches remain the same, even with ESG, because what matters is how do those ESG factors affect a company's cash flows? So if a company is an oil company, for example, there's a worry about how long the asset, oil prices, and how long they'll be able to produce, which it translates into the cash flows. The fundamental principles of how investors are going to value companies are not going to change, I don't think. It's just the circumstances change. Which companies are doing better or worse will change, but the principles will stay the same.
Well, I'm afraid that's all we have time for today, but thank you so much for joining our program. That was Tim Collar, partner and global finance expert at McKinsey & Company and author of Valuation, Measuring and Managing the Value of Companies, a timeless book. Thank you so much for your time.
Thank you for having me.
And to our viewers, as always, thank you for watching.